Welcome everyone to Revenue Management in OpenAir, another in our Expert User webinar series. I am very thankful for you to be joining us today. And we'll get started and we'll go through the presentation, and at the end we'll leave some time for questions. So prepare those questions along the way and we'll see if we can't get you some answers. So here's what we're going to be talking about today in this short webinar. We're going to be talking about why to do revenue recognition in OpenAir. Sometimes there's really a basic question of should we just do invoice and treat forecast billing as forecast revenue, or should we be doing revenue recognition? And I'll give you some examples of things that would help you make that decision. And then we're going to actually look at the revenue rules. So those of you who are aware of revenue in OpenAir, there is actually quite a bit of flexibility in this section of the system. And there's 8 different types of revenue rules. So what we're going to do is not only introduce them, but give you some considerations and typical scenarios on how they can be used, things that you may not have thought about before or have been challenged in trying to solve in your revenue recognition problems. And hopefully the slides or the examples I give you some ideas on how to deal with certain scenarios in your revenue policy. We're also going to talk about accounting periods. Now there's a whole other webinar that we did last year. I did in conjunction with Tim Groves from NetSuite OpenAir, where we did talk about accounting periods as a general functionality within OpenAir. But I find that accounting periods are actually something that come up quite often when we're talking about revenue. And we'll talk about examples and how to set those up and the impact of using those in the system. Then of course there's always time for reporting. So we're going to talk about reporting and specifically how you can take advantage of some of the ways that you can generate revenue to be able to do the reporting effectively and handle things like deferred revenue balances. And speaking of deferred revenue balances, we're going to go over some deferred revenue options and including talking about not only the way OpenAir does the standard deferred revenue tracking, but a year ago, or almost a year ago now, there was a concept called revenue containers that were introduced. So I'm going to go through the revenue container functionality briefly and show you that as an option that you may consider to help you track transactional journal entries related to deferred revenue and accrued revenue. So here's the basic question is, should I do revenue recognition in OpenAir, or can I just deal with invoicing and not deal with revenue? And for those of you who have your standard T&M or fixed fee type projects and the revenue is completely based on invoicing, then absolutely, revenue will give you limited additional information. So if you invoice it, you recognize it. That's a very straightforward revenue recognition policy. Invoicing is something that can take care of both sides of the fence. But there are some even if you're in that situation, I find that customers that would still benefit from revenue, they tell me that everything's T&M or milestone, but then they come back. But we have this weird exception that we have to deal with, which is prepayments, or somebody wants to, they're at the end of their fiscal year and they want to invoice us in advance so they can get the money out the books, but they have obviously a credit now that we have to track. And boy, we have a hard time kind of keeping track of that in OpenAir. And my natural question is, well, do you do revenue recognition? And the answer usually in that confusing situation is, well, we don't do revenue, we just do invoicing. And that's one of the drivers for revenue recognition. So if you find yourself sort of tracking prepayments on somewhere, accounting folks have a sticky thing on their computer to make sure that they draw down deferred revenue balance, revenue recognition may be for you. Another thing that tends to drive the use of revenue recognition are things like when he does milestone billing or milestone invoicing, or some people call this, it also could be a payment schedule. So the company purchased a large fixed fee engagement, but they asked to break it down into 25%, 50%, 75%, and 100% chunks of money. That may not have anything to do with the way that you recognize revenue. And in fact, many times customers in these types of situations are recognizing the revenue as work is delivered, so more of a percent complete model or a T&M revenue recognition. So that is where invoicing diverges from revenue, and tracking revenue in OpenAir would be very beneficial. The other one, which is a little more elusive, which is an interesting one I find, is if you have to deal with product sales and services, companies tend to have to fall under this reporting or this audit mechanism called VSOE. Vendor-specific objective evidence. And what that means is, although you may have made the customer to say, okay, the services are free, but the license is going to cost you X number of dollars. Well, according to VSOE, you can't actually give away services, so you have to revenue share across that discount. So you have to discount both the product and you have to give money over to the services side. And for those of you who are in the situation, you're probably all too familiar with it. But what that really means is you're generating an invoice with one rate because the customer sees it in the contract as rate, I don't know, $0 or $50 an hour or something like that. But behind the scenes, you're actually recognizing the revenue from a services side at a normal rate, a standard rate that would be compliant with VSOE, like $100 an hour or $150. So, how can you invoice at one rate but recognize in a different rate when you're dealing with timesheet data? And I'll show you an example on how you can do that. And of course, the thing that happens that impacts some of us as small companies is that we may not have the luxury of saying if we invoice it, we're going to forecast it as revenue. We actually operate on a cash basis where we have to wait for invoice payment, and then actually that's considered revenue. So there's a variety of scenarios, and there's more, but these are some typical examples that drive the need for revenue recognition. So, here are the rules. And for those of you who are familiar with revenue recognition in OpenAir, you've seen these rules before. They're in the drop-down when you can go to create a rule. And everyone actually has the ability to see the rules in the system. So what are the different types of rules? Well, we're going to step through them one by one. But as I step through each one, we're going to talk about what to consider and what are some of the examples or scenarios that would fit this kind of use, okay? So let's talk about the as-billed rule. And conceptually, this is probably the simplest rule short of fixed fee that you could have. If you bill it, you recognize it. So great. If it's on, if I invoice it or I generate it through billing rules, I can recognize it as revenue. But the as-billed rule, even though it's extremely simple, has a lot of flexibility, and there are a lot of dependencies that you have to consider when you're doing revenue recognition with the as-billed rule. Things like, so if I process things for billing, for invoicing, can I recognize them before I invoice it, or does it actually have to be on an invoice? And for some of you, the answer is, well, of course it has to be on an invoice. And for some of you, it's, well, no, it doesn't. Of course it does not have to be on an invoice. There's actually internal switches that control whether you have to have it on an invoice or not. Then likewise, if it has to be on an invoice, well, does the invoice just have to exist, or does it have to be actually in an approved and sent state so that it has been officially sent to the customer, and now the system can recognize that as revenue? So yet one more, and this is also an internal switch, to control at what point on invoicing does it allow you to take the revenue, okay? There are other things like what kinds of charges would you recognize as revenue? So on the as-billed rule, you have the option to say, I only want to pay attention to hourly charges or expense charges. Maybe expense charges are not revenue, only fees are revenue, so hourly and fixed fee. So what kind of charges constitute revenue recognition? And of course, how are revenue recognition transactions categorized? Many of you are using something called a service, and you may have renamed it to things like GL code, part number, material ID, activity, things that are more related to an accounting system. And these are the classifications of where that revenue would be reported in the different GL accounts. So maybe hourly goes to a fees revenue bucket and expenses goes to an expenses revenue bucket because it's really not revenue, it's maybe offset, offset cost type thing. So, how do you set up an as-billed rule that kind of covers those two situations? So I took the liberty to kind of take some of these examples and throw them into scenarios of, well, how would the billing rule look? How would the revenue recognition rule look? And what would be the result of these things? So let's take any kind of billing rule, fixed fee, time and material, doesn't matter. And you've got the simplest as-billed rule on there that says, I don't care where the charge is. I don't care if it's on an invoice. I don't care what the service code is. When you run the revenue rule in this situation, anything that was charged, anything that was generated through billing will be picked up as revenue. And in fact, anything that was processed as billing, whatever the service code, or the category of counting it is, it will be stamped on the revenue transaction as it was billed as well. So this is the simplest, no controls, no holds barred, no hurdles as-built rule. And that's how a lot of people think of the as-built rule. But here's some things that you can take advantage of with the as-built rule that leverage the fact that it has some filters and some powerful capabilities. So what if you're doing a time billing rule and expense billing? So time and expense, T&M type project. However, you need to make sure that the revenue for expenses is categorized against the revenue, the expenses revenue code, and the revenue according to the time billing or the fees is located against the fees revenue code. So in fact, in this case, you actually set up two as-built rules, but one rule is only looking at expense type charges, so you filter out everything else, and the other rule is only looking at fees or time type charges. And in each of those, you actually set or hard code the service code on those rules. And in this case, I'm saying that invoicing isn't required. So as the revenue recognition is coming in, it's categorizing the revenue according to the rule setup. The next scenario, many of you may be familiar with, it's usually referred to as the ghost charge scenario. And this is where you have a fixed fee invoicing situation, but behind the scenes you're recognizing the work delivered as time and materials. So every hour that's worked, you actually pick that up as revenue. So you have a time billing rule, but you're using something called a charge stage to throw those billing charges or those invoice charges into a group of items that will never be on an invoice because the customer doesn't need to see this level of detail. So what happens is the recognition rule, the as-built rule, can be picked up, but you can actually tell it which of the charge stages to pay attention to. So here it's going to ignore anything that actually is being invoiced. It's only going to look at the non-invoiceable stage. And I'm not going to say invoicing is required because it would never be an invoice. So in that situation, I actually only pick up the non-invoiceable charges for revenue, and I make sure, I also as a safety check can say I only want to make sure I pick up hourly items. And of course the last item here is what if invoicing is required, then of course until you actually do invoicing in the system, you would not be able to recognize revenue. So there's some options there and a couple of internal switches that you may have not been aware of and the filtering options that you can put together even with just simple rule. The percent complete revenue recognition rule. I really like this rule. The concept is very simple. It's basically however complete the project actually is at this time, take that percentage, multiply it by the total revenue available to recognize on the project, and figure out what my current revenue is, recognition is for the project. So the project's $1,000, it's 25% done, I can recognize $250. The next month is 50% done, I can recognize $500, so I recognize another $250, and so forth and so on. Real basic concept, but again, there's a lot of things to consider because what does percent complete mean to you? And percent complete usually means I have approved effort over some kind of plan of effort. So how do you plan your effort? Do you plan it based on the hours that you assign to tasks? Or do you use something more advanced like estimates and remaining hours on tasks? Do you assign people individual levels of effort on the task, or is the task itself the owner of the hours? So you have a task, it's 10 hours, you assign 3 people to it, everyone gets 3.33 hours. Or is it, I've got a task, Jody gets 2 hours, Cindy gets 4 hours, and Michelle gets 4 hours. So the total of the task is 10, but each person has their own bucket. Okay? Those type of configurations, and in fact that's probably how you're doing project management, will drive how the percent complete calculation will work. Are you using hours remaining on timesheets? Because that actually can control the estimated hours, and if you're doing estimate approved over estimate, that actually impacts percent complete. Are you putting milestones together under a phase? So you have a phase of quote-unquote billing milestones, and do you understand the impact of doing that when you're setting up percent complete activity? Then of course, when do you run revenue? Which is actually a really simple question, but it has a big impact. Because the percent complete rule, when you run it, it actually recognizes everything up to the point of the day that you're running it. Even if you put date ranges on that recognition transaction run, it ignores the date ranges and gives you what the current value is based on the current percent complete. So timing of running this rule is very important. So what are some other options on the percent complete? So I took a quick snapshot of the percent complete rule. And here are the options for you to actually allow the system to figure out what percent complete means. So there is the official percent complete calculation, which is either a project tasked or rule-based tasks, okay? And then you have other options such as controlling it literally with timesheet hours and planned hours for the project. So no matter what your percent calculations are in the system, you can override it based on how you want this rule to run. And an interesting one, just to call your attention to it if you're not aware of it, there is an option for you to just do a very simple percent complete of the approved hours over the total budget hours on the project, which is on the project properties form or the edit project form, depending on your UI. And that budget hours is something that if you want to adjust percent complete, well, you could always adjust the budget hours. It's a one value change. You don't have to update tasks or anything like that. And so this is sort of in a pinch trying to fix the percent complete rev rec rule, but it is an option. It's the simplest way to do percent complete, and it doesn't require a lot of calculation. So if you're doing task-based percent complete, that's the actual value of percent complete, 25% complete, 50% complete. There are two calculation types. The estimated hours is recommended for the percent completion calculation only if you are assigning hours to individuals on the task. Because unless you give people a specific budget of effort, them entering any kind of hours remaining will not impact the estimation, and that without impacting the estimation, it won't change the percent complete. So in order for you to use estimated hours and remaining hours, you have to assign people individual budgets of money on the task level, which may take more effort to set up the tasks if you're not aware of that. And I'll show you that in the system really quick. If you're using planned hours, then actually you can leave the calculation just to be approved over planned. Don't mess with the estimated because the estimated will always be the same as the planned anyway. So if you're not familiar with sort of the hours assignment to the individual task level, let me go into the system. And I'll just pick a random task that I have in my sandbox. And I use the assignment per hour basis. So the individual person is assigned a certain number of hours. And based on how they've entered time in the system, they have the ability to adjust the remaining, which impacts what's called estimated hours. So let's say Curtis was given a 6-hour budget on this task. He ended up working, wow, that's way over budget, 251, and he says, but I still need another 40. So he's adjusting his remaining hours, not to be negative, but to actually be a positive value of another 40 hours on his timesheet, which of course has a huge impact on percent complete. If I was only doing planned hours, approved over planned hours, this task would actually always be 100% complete because I would have gone through the approved hours or the planned hours very, very quickly. So you can see the percent complete is basically 0 because I have an estimation and remaining hours option going on. So let's talk about fixed fee on complete, percent complete. So this one's easy to get confused with the last one, which was the percent complete option, because percent complete is a dynamic calculation. So depending on how many hours have been worked against the total revenue plan, it will figure out how much revenue you can take. The fixed fee on percent complete is actually focused on when I get to an X amount of percent complete, I can take this fixed amount of money. So the percent complete rule computes it. The fixed fee on percent complete gives you a fixed value when the project reaches a certain percent complete. So the considerations for this rule are pretty straightforward. Is basically, do you know at what point in time in percentage that you need to take a certain amount of revenue? I rarely see this fixed fee on percent complete used only because that tends to be more of a milestone billing type activity, and the revenue recognition tends to be related more to the percent complete or the as-built. But a common scenario for using this fixed fee on percent complete is to set up sort of a cleanup recognition rule. So So let's say it's a fixed price project. You've got $200,000 maybe in contingency just in case you guys get into budget problems or work problems on a fixed fee problem. So you've got $200,000 held back. And what you can do is create a fixed fee on percent complete that says when the project is 100% complete, I'm going to pick up this last $200,000. And you can always adjust that $200,000 as you're pulling from contingency should the project get into any kind of trouble. Things to keep in mind when you're running the percent complete rule, and this is, sorry, the slides are a little out of order here. On the percent complete rule, timing is very important. So when I run the percent complete rule, it will recognize all of the revenue to the day that I ran it. I just had mentioned that before. So even though when you run revenue recognition, you get the option to basically pick a date range in many cases. We'll stick with the presentation for now. It will ignore that date range and it will give you exactly what the revenue is today. So a great example is month end is January 31st, and we finish all of the invoicing by February 10th, and we go to run revenue recognition on the 12th. Okay? When you run revenue recognition on February 12th for January 31st, it actually picks up all of the effort so far that's been approved up to February 12th. That will probably overstate your revenue recognition for the month of January. So timing is very important when you run the percent complete rule. The other thing to keep in mind, and this impacts both the percent complete rule and that fixed fee on percent complete, is the phase level roll-up percentages. So commonly people will take a series of phases and they'll link them or roll them up under a phase title. So you sort of have a nice organized structure of your projects. And in some cases, if you close those tasks, it will automatically set tasks to 100% complete, or you give project managers the ability to edit that percent value, and they will be able to turn it to 100% complete and save the task or the milestone. Okay? Well, that's all good and well. So if I have anything attached to those tasks or those individual milestones, and I close them or change the percent complete to be 100%, then that would trigger my fixed fee percent rule, for example. However, at the phase level, the phase recomputes percent complete based on the roll-up of the hours that have been planned for the phase and a roll-up of the approved hours. So let me show you the example here in the system. So here we've got the change orders phase. The change orders phase has a total planned hours of 5 and approved work hours of 11.5. Okay? Because that is a roll-up of the individual tasks here that have 1 hour for the resource profile load and 4 hours for service updates on historical transactions. Okay? Completely makes sense. But you'll notice something here is that the fact that this task 29, was planned to work for 4 hours. We actually did a little bit more, 4 hours and 15 minutes. So it's actually computed that to be 100% complete. And the project's and the task is closed. The resource profile load was estimated to be 1 hour, but it took us 3 hours. But we finished this item and we closed it. So that's also 100% complete. But the other two, they don't have any effort. They're 0% complete. So if you look at what happened to the phase does not average percentages across this. It's actually rolling up and saying, oh, I have a total of 5. I've worked 11.5. I therefore am 100% complete on this phase. That may not be what you intended. It gets even trickier, and I discovered this with the customer actually, when you have a phase of milestones that roll up. And what some customers will do is instead of attaching a percent complete rule to each individual milestone, maybe they'll say when all the milestones are closed, I'll go ahead and recognize all the revenue. So they'll set up a revenue recognition rule on fixed fee and percent complete that says for the milestone phase, when that phase is 100% complete, I'm going to recognize $50,000. And that sounds like a good option. But as I'm going to show you, this milestone 3 is closed. The milestones phase is still at 0%. If I close milestone 2, and I close milestone 1, you'll see that all my milestones are now closed. But the phase percent complete. That phase is still 0% because for the phase, it's trying to take the planned hours and approved hours and fix and complete. But 0 divided by 0 still gives me 0 in this case. So I have to physically go and close the phase. Okay? And even then, that didn't set the phase to 100% complete. So the fact that I set this rule up to trigger off of this milestone phase roll up to be 100% complete, that rule will never be satisfied. So that's something just to be aware of if you're doing fixed fee percent completes and you're sort of organizing things by billing milestone. The phase roll up doesn't recognize the percent complete the way that you may expect it to in like a system like a formal like a Microsoft project plan. The expenses or purchases rule, the basic concept here is basically recognize revenue for expenses and purchases, specifically those types of charges that you can create from billing rules. But the considerations here are, is your company using multi-currency? The reason is that when you go to invoice expenses or purchases and you have to do a currency exchange rate or conversion, the date that that conversion, that exchange rate lookup may be for invoicing may be driven by the invoice date. What happens is when you run the revenue recognition rule for just for expenses or purchases, it actually will use the transaction date to look up the exchange rate table. And in some cases, that may not be the same thing as the invoice date. So you can see that may come to cause a little bit of a problem because it's using its own index into the exchange rate table. So you may get a little bit of a deferred revenue or work in progress revenue difference between the invoice amount because the exchange rate is just slightly different enough to change the value. So I actually really recommend, unless there's a really specific situation, is that you stick with the Asbuilt rule to pick up these types of these revenue items and not use the expenses or purchases rule directly because of that individual or unique exchange rate index. And the last one is fixed fee on date or milestone. Again, this is probably, in addition to the Asbuilt rule, the most simplest, but it also, you know, there's not much you can do with it. You put a date in there and an amount, and that's when you can recognize the revenue. But the scenarios that I see this for are really sort of revenue adjustments or the contingency at the end of a project, pick that up as revenue because you put it to the side and now you can recognize it. The adjustment is more of things like, you know, I've seen situations where we actually have been billing the customer at X rate, but we realized it was a VSOE situation and we should have been revenue recognizing at a much higher rate. So the revenue books are closed for the past 3 months, and now we can't restate revenue. What we're going to do is put a journal entry in to basically augment the fact that we had missed out on revenue the previous 3 months, and we'll just do a catch-up to fix the revenue total. So that's where I can see this rule being used. There is a rule called incurred versus forecast, and the concept behind this is it's a cost-based revenue recognition model, which means if you have variable cost on people, the more expensive resources at work hours recognize revenue faster than the lower cost resources that you work on it. So of course the big questions here are, well, are you actually tracking cost on users? And if you are, how are you planning the cost, or how are you managing what is the plan of cost for that project? Similar to the whole plan of effort for the percent complete rule, but here we're having that in addition to the hours, it's the cost factor. And again, it's when do you run revenue, because this is the same kind of timing problem as the percent complete. So this rule, it's a pretty straightforward setup, but it's actually got a lot of smarts behind it. So you put the total value of the project in there, and then you can do things like, okay, as hours are approved, that gives me my incurred value, my actual, you know, approved effort. And for forecast, I like to use approved and booked hours, which means I'm using bookings as my plan of cost. So that gives me my baseline of cost. And so the timesheet cost from approved hours divided by the plan of effort from the bookings cost, which is also the user cost, gives me my percent complete, which then multiplies by the money. As effort is approved, the approved cost and the cost baselines per person generate transactions. So the interesting thing about this incurred versus forecast rule is this is the only rule that will allow you to automatically, based on time entries, and cost splitting based on work per, like the percent complete. I'm stumbling here. But the percent complete rule, when you run it, you recognize a single transaction against the person who actually ran the revenue rule. The incurred versus cost forecast rule is interesting because you can actually, even if you run the rule, you can actually have it split out the revenue transactions according to each person based on their effort. So this is one of those rules that people consider when they have fixed price projects, but they have to have revenue attribution per user, so they have some kind of compensation model based on revenue. So I'm going to show you what that looks like in the system. So I have this recognition rule on the system and an incurred versus forecast rule. $100,000 based on approved hours and approved in book plan of effort. And when I go to run revenue, and where I'm going to run revenue is a little different because I have revenue containers on. So if you're not used to seeing this, it may look a bit strange. But here's my incurred versus forecast rule. And so basically, based on the activities that these 4 people did, they all earn a portion of the total revenue based on the cost of that resource and the effort that they worked on the project. So this actually takes a single fixed fee value that it would compute for percent complete and splits it across people. So this is actually a good option if you have to deal with revenue per person. The interesting thing is, and I completely contribute this to Tim Groves at OpenAir, if you actually want this to turn into, well, I just want this to be percent complete on hours, and not have to deal with cost. If you set everyone up to the same cost, that's essentially what you're doing. So everyone contributes the same cost rate based on the hours they work. So if you standardize on a cost across people, you turn it into an hour incurred versus forecast rule, almost like a percent complete, and you can split the transactions up by person. The last one is the time project billing rule. And the basic concept here is you can recognize revenue directly from timesheets. Avoid invoicing altogether. Of course, many of you may be cringing on that, but there are some reasons that you would want to do this. And really the questions you have to ask for this is, do you require invoicing before you can take revenue? Okay, if the answer is yes, then this is probably not the rule for you. But are you taking a different revenue rate versus what you're invoicing the customer? This is that whole VSOE thing, okay? So here's an example for VSOE, and I also call this term this license carve-out. So an example is that I actually am setting up rules. Time billing rule 1 is the one that's going to invoice the customer. And so the customer is getting invoiced every hour for $85 an hour. Time billing rule 2 is the one that I'm actually setting up to drive revenue recognition against this time project billing rule. And once I have this time billing rule 2 set up with a different rate, I attach it to the recognition rule, and I'll show you what that looks like in a second. Once I've got that attachment done, I can actually inactivate the billing rule so there's no conflict as to where the timesheets are being generated. So as I go to create a time project billing rule, the strangest thing that you see is when you create it, it says, which billing rule do you want to attach it to? So this is a revenue rule. But the revenue rule, instead of recreating all of the same rules and functionality on the time billing rule, they basically just said, okay, use the time billing rule as the driver for the feature functionality, and then just attach it to this time project billing rule, which is a revenue recognition rule. So you have to set up the time billing rule, check this box, then you can actually go and inactivate the time billing rule so that there's no confusion. So the caution, again, I have to say is when you do this kind of setup, you actually are recognizing revenue directly from timesheets, and there's no invoicing dependency. Okay? And the tip is if you inactivate the time billing rule, you'll avoid any kind of charges or confusion about the possibility of duplicate time processing. A time entry can only be processed by one rule and one rule only. So for billing. So if you have 2 time project billing rules, one of them is going to win. If you inactivate the one driving this recognition rule, then there's no question as to which one's in charge. Okay? So I've actually set this scenario up. in this project. So I have a time project billing rule, which is attached to this time billing rule number 2. So if I go over to billing to see what the driver is there, I have time billing rule number 1, which is $125 an hour, and I have time billing rule number 2, which is a rate card. And in fact, I'm going to go ahead and inactivate this. So now there's no confusion. There's only one time billing rule that's active. And if I go back to the revenue recognition, you'll see that this rule is still active as well. So watch what happens when I actually run revenue recognition. So here is all of the timesheet data is actually being processed by that time project billing rule for revenue recognition. And the rate is actually $175 an hour versus the $125, which is what the customer was going to see. Accounting periods are something that are very useful because sometimes you're actually taking revenue on a different date or a different month than when the invoice was generated. So a great example is like I do on the cash basis. I invoice the customer, they get net 30 or net 60 payment terms, and then they pay me 45 days later. I recognize the revenue 45 days later. So it's actually not in the same month as invoicing. It's 2 months later, basically. Another example is you're doing the invoicing. The invoice dates are on the 1st of the month for the previous month. So the invoice dates are February 1st, but the revenue is actually January. So if you want to make sure that the invoice date may use an accounting period as well for January, and the revenue all gets stamped with January. So even though the customer sees February 1, everything is really associated to January. And accounting periods are something that allow you to set up a series of periods so that you can set that as a default on the rules in the system. And the example of the defaults on the rules are in the rule, you'll have an accounting date section, and you can use defaults to say, use the accounting period below and what is the current accounting period. The current accounting period can be designated in these accounting period setups. Then as you run financial reports to make sure that the revenue is reported in the right period, you basically use the index for recognition transactions to say, don't use the transaction date, use the accounting date that's on the transaction, and that will make a big difference in how the revenue is reported according to the periods, especially when you're talking with your folks at finance. The reporting aspect of revenue recognition is something that I encourage accounting to get involved in, especially to reconcile OpenAir with whatever accounting system you may be using, especially if they're not integrated. And OpenAir provides some standard fields. Obviously, there's invoice values, there's revenue values, but OpenAir will also automatically compute a standard deferred revenue value and a standard thing called work in progress. And this is where you've actually invoiced more than you've worked. So you've got sort of pending revenue out there. Or I may have actually just completely reversed that. If you invoice, then you recognize you've got deferred revenue. If you work more than you invoice, it's work in progress revenue. Okay. For reporting, you may actually need to break information down different than those 4 standard fields, because accounting wants, okay, I don't want just the revenue amounts. I need the revenue broken down by fees versus expenses. And I need the deferred revenue by fees versus expenses. So I can align things to the different service counts, the general ledger account codes, things like that. So you'll probably end up having to get involved in custom calculations like the one I have on the screen here, which says, what is the total amount of revenue that I've recognized, but subtract out any revenue recognition from expense items. And this would basically give me my fees type revenue. And I could call this fees revenue, and that would give me something to report specifically to accounting so they could understand how to reconcile that with their accounting system. Another thing to consider is when you're writing a report for revenue management is custom time ranges. And specifically, it helps with deferred revenue reporting, I find. And the example I have on the screen now is actually a custom time range that says, give me what my beginning deferred revenue balance is. So for those of you who are involved in the financial systems, this is probably no big, this completely makes sense. I have my starting deferred revenue balance, and then the month of January I did some work, and then at the end of January I have the ending deferred revenue balance. Well, you can mimic that information in OpenAir by a custom time range, and you'll see that in this report I have a past area. So this is my beginning balance. That's what this column represents. And then the month of December is the work that was delivered. So how much revenue did I pick up? And then the total here is what my ending balance is for my deferred revenue. So I've got my beginning balance and my ending balance along with the activity that happened in the month of December. So how did I get the report to come in this format? And that's actually something called a custom time range. So it's in the administration panel, and it's a real simple setup just like this, where I said the past starts way back at the beginning of time. So for me it was 2006. The December starts on December 1st, so the pin's on November 30th, 2011. And then I stop the custom time range to say, and the end of this time range is January 1st, which implies December ends on December 31st, 2011. And just setting this up, it's consisting of two periods, period 1, which is past, and period 2, which is December. I can actually run a report that says, give me, based on this custom time range, 2 periods, and this is the information I get. So you get your beginning balance and ending balance, which accounting would probably be most very interested in. And the last topic we're going to cover, so we'll open up the phone lines for some questions here in just a second, is deferred revenue options. So OpenAir does have a deferred revenue standard calculation based on invoiced amount recognized so far. So it can report on deferred revenue. That's just a reporting value on summary reports. But there is a concept called revenue containers, and I've run into the usefulness of these when there is a need to track the fact that I need to understand every monthly activity, what are the journal entries or the transactions that are for that month. So what revenue did I defer this month? What would I accrue this month? And if you don't use the revenue containers, you sort of get balances, starting balances, end balances, but you don't have the individual records. There's no records for deferrals, and the balance always changes. The value always changes to be what the current value is. So the revenue containers allows you to basically create a way to package up the revenue into a group, a container, and you can actually submit that for review and approval even, and when it's approved it will actually generate transactions called deferral transactions and accrual transactions. So if you think in terms of an invoice in OpenAir, you run billing rules which generate charges, and then you create an invoice which scoops up the charges onto the invoice. A revenue container has the same concept except it's looking at revenue transactions. And the container scoops up the revenue transactions, and then when you approve it, it actually does an additional step, which is create these accruals and deferrals. When you have revenue containers turned on, you actually have to define revenue stages, and these are the holders of all these transactions. When the revenue is completely recognized, it actually is booked as final revenue or final booked revenue, so it's recognized revenue. So what you do is actually you run revenue recognition. In order to run revenue recognition, you do have to use the auto run feature. Then you can create a revenue container, and it'll grab all the revenue that's currently available to put into the container. So anything that's a recognition transaction that's created, it'll grab on the container. Then you can submit the retainer for the container for review and approval. And once it's approved, it will go through and generate whatever it thinks the deferred transaction and accrued transaction is based on displaying it in the container. So I'm going to walk you through an example here, and we're going to do a live demonstration. So let's say that no invoicing has been done at the start of a project, but we get to recognize 25% right away. We worked 25% of the project. So we haven't done any invoicing yet, but we can recognize 25% of the project. So I generate a revenue transaction for $10,000, and I create a container to basically grab that $10,000, but there's been no invoicing. So it's going to propose that this is an accrual transaction, and I'm going to submit that revenue container for review and approval. Once it's approved, I have $10,000 in accrual revenue. Now I invoice for this customer. Then I go back and I can generate another revenue container now because there's been a different activity that's happened in the system. So I can generate a revenue container even though there's no revenue. But the revenue container will say, oh, now you've invoiced $25,000. You have $10,000 in accrued revenue. I'm thinking you should have $15,000 in deferred revenue. So you submit that revenue container, and it will generate the $15,000 in the deferred revenue activity. The accrual transaction is still there, but basically that accrual transaction is now zeroed out because you've been able to take that revenue. So I'm just going to show you this in the system real quick. And when you turn on revenue containers, you get two additional areas. You get the recognition transaction list here in the invoices module and a revenue container. So equate this in your mind to revenue transactions are similar to billing charges, and revenue containers are similar to invoices. Okay? So you look at the transactions across projects through the invoices module. So if I run revenue recognition, and I'm going to continue to use our little example project here. Here's all the revenue that I want to recognize. And you know what? I'm going to go ahead and recognize all of that. So I'm going to create these transactions. So now I've created some transactions. Oops, I must have unchecked these. So there's revenue. There's open revenue in the system now. So if I go to open, you'll see for Dig Dug, there's a lot of revenue recognition out there. So now I'm going to go ahead and I'm going to create a retainer, a revenue container. And the only, the Dig Dug project has some revenue now, so I'm going to go ahead and create that container. And what the container is going to do is says, based on what previous activity has happened, here's the balance before I created this retainer. I was at the container. I was at $25,000 being invoiced. Okay, I haven't done any more invoicing, so I still have $25,000 in invoicing. But the revenue that I just generated was $187,000 of that. So based on this, I had created a retainer before, a container before this that had no revenue in it at all. So what it's going to do is it's going to say, well, you can actually take $25,000 of it because you've invoiced that, but the rest of it is going to be an accrual transaction, so $162,000. So I'm going to go ahead and submit this. And so this container keeps track of the fact that this activity happened and this is what this transaction, this container did. So if I go back and I look at deferral, you'll see that I have the deferred amount of, I deferred the $25,000 from the original container, and now I can actually zero that out and I can recognize that revenue. And then the accrual is going to be this huge amount of money, $167,000. And as far as final, you'll see that I was actually able to recognize the $25,000 because I had already booked that as revenue in the system. So this definitely, this quick review of this option is, I oversimplified it. It actually is quite complicated, but it is useful, and it provides sort of transactional snapshots each month as to what happened. And it may be helpful for you as well as your organization needs to see what happened month after month versus just ongoing totals. So just keep in mind that revenue is a very powerful function in OpenAir, and there's a lot of rules, a lot of flexibility, and probably the hardest part is figuring out which one to start with and how to set it up. So definitely, hopefully these slides will help you kind of make some decisions on that. You can play around with stuff like that because revenue is one of the easier things to sort of delete back out of the system if you need to on some test projects. But definitely there's a lot of opportunity there. And you can always have a copy of the slides if you'd like. If you need to get a hold of us for any reason or you have some follow-up questions, you are very much encouraged to email us at info@topstepconsulting.com. We also have a Twitter address on TopStep Tweets where we send out information such as the weekly tips and a blog that I'm writing. And we also are active in the OpenAir users LinkedIn group, which is a good source of sharing information or helping others with information within the OpenAir user community. So I want to thank you very much for your time today, and have a good rest of your evening, day, or morning.